Fantastic. So, hello, everybody. I hope you are all doing well and you are all having a great trading week so far. As always, I'm extremely excited to be here. And if you are new to those sessions and to Funding Pips, then welcome. We are doing those sessions twice a week. We are doing them on Sunday and on Wednesdays. Sunday, we open up the topic during the webinar, and on Wednesdays, we extend that topic into the workshop like we are doing today to give more insight into the topic and make it more relatable to your trading journey and to make it more actionable. We always want to ensure that we provide you with knowledge and insight, but then we implement it to create that momentum for you. And then also on every Friday, we have Traders Roundup at 7 p.m. UK time on Discord. So this is where you can just share how your week has been, and I can kind of help you reflect and then help you move on to the next week with kind of more fresh perspective. But let's focus on today and today's topic. And today's topic is about breaking down your trading edge with help of probabilities. So in a Sunday session, it was a webinar and we talked about that topic, and it was more about understanding the topic, about what are probabilities and what really is your trading edge. And we are going to recap some key things from that session in order to move swiftly into the workshop. So if you haven't attended that session, please still stay here because it's still relatable to you and you can always catch up. But I really want to dive into some nitty-gritty stuff today so you can really take time to reflect what a trading edge really is in terms of you and how it should be suited to you and what probabilities within your trading edge mean. Because in theory, everybody understands it, but not many actually implement it, because implementation would mean that you are fully okay with the randomness of the results that you receive from each trade that you are going to enter. But actually, that's not the case, because the markets don't want you to lose, or perhaps debatable, but the markets are not there to make you have to be right all the time. It is you that wants to be right all the time. So this is the reason why we are going to talk about this topic in more depth, so you can really make peace with certain things and allow for your brain to process things differently, because as we know, it all starts in our minds. So webinar recap, we talked about your edge in the markets. What is your edge and probabilities in action? So first of all, in simple terms, your edge in a market is going to help you succeed as a trader. And your job as a trader is to produce consistent results from the market that will produce returns at random. I'm going to repeat that again because it's extremely important. Your job as a trader is to produce consistent results from the market that will be produced at random. The returns will be produced at random. So when we are talking about your edge, we don't just mean technical edge and we don't mean just psychology. Neither or is more important. So let's put all of that debate to bed that says you should learn your strategy and not really focus on trading psychology, or you should focus on trading psychology and really put to bed your technical analysis. It is both. And it is about understanding the probability part, which is the numbers, because one very much facilitates the other. So it's really all about understanding your technical edge and your technical analysis, and we're going to dive into it. It's not just about understanding the strategy alone, but the numbers behind the strategy and what your technical edge actually means, which I'm going to help you to break down the things that you should be paying attention to. And it is the mental edge that you need to cultivate and you need to develop, because overall, trading is about mental excellence, because you have to allow for the numbers to play over a long period of time. So even when you have strong technical edge, which is necessary, you need to have strong psychological edge to allow for those random returns to play out over a longer period of time. And your insight into your technical analysis and insight into your mental analysis really should inform your risk management, because risk management and overall trading is a very individual sport, and there are a lot of different things to consider when it comes to that. Because if it was just down to technical analysis and single strategy, we already know that there are strategies out there that are profitable. However, not everybody who learns that strategy is profitable. So that tells you that it doesn't depend just on the strategy, but the person behind the strategy. And that person is you. And you need to spend time on understanding yourself, how your brain works, how you need to rewire your brain, how you need to get to know yourself from the perspective of psychology, mindset, limiting beliefs, growth mindset, what works for you, what doesn't work for you, what helps you grow as a trader, what are your strengths, what are your potential weaknesses. Are the weaknesses that you're experiencing something that you can eliminate, or is it something that you need to grow through and allow yourself to actually evolve? So all of those things are really important to understand. And the best traders, the best traders do not look at their daily outcome, but they treat a period of time as a mathematical equation in the same way as casinos would. So in order for you to be able to look at a longer period of time as a mathematical equation, you need to build that mental excellence to take you there. But before we are going to do that, I want to focus on actually you understanding what it is that you need to do to achieve that. And I want you to understand how probabilities actually work in action. So I am going to repeat the same thing that we discussed on Sunday to just highlight the importance of probabilities. So this is where I highlighted in the last session that it is important to take the example from casinos. And it's a controversial topic because trading often is compared to gambling. Now, gambling industry, though, the house, not the player, the house always wins. And there is a reason for that, because they always have that mathematical edge over a long period of time that is going to allow to cultivate the money. And essentially what you need to do as a trader, you need to become the house, not the emotional player that enters the house. So I'll give you an example of a certain game of blackjack in a casino and how it works. So in a game of blackjack, casinos have approximately 4.5% edge over the player. Based on the rules of the game of blackjack, this of course requires a large sample size. So it's not measured on just one player's performance or on one table's performance, but the number of hands that are played. So what it takes into consideration is the total of all customers per day, per week, per month, and per quarter. And this is how casino will always generate 4.5% on every dollar spent in the casino on the game of blackjack. So now remember this, that it includes the big winners, the big losers, and the break-even trades. So this works out as something like 4.5 cents for every dollar that is spent on the game of blackjack. So if you think about it, 4.5 cents for every dollar spent does not seem like that much. But over a period of a year, that allows for the casino to gather $4.5 million in profit. So all of that allows for the casino to achieve what they want to achieve and to get that numerical edge over the player is because there is a golden rule that they follow. They never change the rules. And remember, the next slide, actually, we're going to talk about variables uncertainty, but in action, so more in action than we did in the webinar. And there is a very important thing here. This is all measured over a longer period of time. So the casino and the single table is going to receive a number of different customers. Some customers will big win. Some customers will lose big. Some customers will be somewhere averaging at break even. Now, there might be a streak where the casino will be faced with every single day customers that are winning big. Then at random. We don't know how and when. There might be customers that will be losing big, etc., etc. However, even if the casino has customers that are winning big, so that way the house is losing at the time for the duration of that week, that game, that table, that day, that week, that maybe not a month. But the point is here that they don't think to themselves, oh, do you know what? We have a fourth customer or 14th customer or 400th customer on a fourth day, and they keep on winning. So do you know what? I am going to adapt the game of blackjack because I can see that I am on a losing streak. Therefore, I need to adapt. I need to adapt the risk. I need to adapt my strategy. I need to adapt how I, hand out the cards. What is the hand, etc., etc. They can't do that, and obviously that would be cheating. But the thing is, us as traders, we can do that, and traders very often do that. That when they undergo the losing streak, they very often put themselves off from actually executing the next trade because they feel defeated. Where if they took the example from the casino and understand that actually, do you know what, the game of blackjack and the dealer always implements the same rules over a period of time, even when they are undergoing a losing streak, I need to do the same and apply the same risk and apply the same strategy and apply the same trades and keep on taking them. So then at the end, I'm going to be okay. However, one of the most important things to be taken into consideration is that you need to have that mathematical edge, because if you are utilizing a strategy that actually doesn't give you that slight mathematical edge over the player, which is over the market, then you will struggle. Whereas in a casino, they are so sure that the game of blackjack is giving them 4.5% edge of every dollar spent, that is how they have the confidence in executing. So that brings us to understanding the variability and certainties of what we're going to be faced with, but also it brings us to the fact that how important it is for you to understand your data. And without that data, going back to the previous slide actually, is the only reason the casino in a game of blackjack is able to execute the same strategy over and over and over and over again, even undergoing the losing streaks, weeks. They will implement the same game, the same rules, the same risk. Actually, the risk may vary because the player's risk may vary. And this is where we're going to discuss that in variables and certainties. But the point is, they do not change it. And they continue going because they know and they have this numerical confidence. You need to have that numerical confidence. You need to understand what is the percentage in your advantage for you to achieve what you want to achieve. So this is why I want to talk about variables and certainties. So about telling the difference, because there are certain things that we have control over and that are certain in terms of the way that we are going to do it. But there are certain things that even in the certainty of the execution, certain things, there will be variabilities that we do not have control over. So speaking of the casino, for example, they do not have control over how many players per table they are going to get. They may get 1 player, 2 players, 3 players on their table or more or less, and the player can always, in a blackjack, play against the house, so the dealer. Now, the variability there is that they do not know how many players will come. Obviously, the players that will come could make him lose, could make him win. So they have no idea what is actually going to happen. So this is something they're not certain of, the number of people, but they are certain that over a number of hands played, they are going to come out on top, but they may have to sustain themselves during the period when they are not winning. They are also not certain about the amount the player is going to bet and they're going to put on the table as a risk. So if that person is going to undergo a winning streak with a very high risk, obviously that is putting the casino out of pocket. However, still, they know that on average, they have that 4.5% advantage. And that advantage is just 4.5 cents per every dollar spent. I can't stress that enough, because this is not even 50 cents. This is not even 80 cents. This is not even 30. It's 4.5 cents on average that they can get, and they still make a lot of money just from that one game. There is roulette, there is poker, there are other games that players are playing, and they have that mathematical edge over every single one. Your certainty in your trading is your mathematical edge. Your certainty is always you, and you need to build that certainty into your edge, because there will be variabilities that you will be facing in the markets as a trader that you need to take into consideration. And as you take them into consideration, you need to make peace with them, because those things will not go away like losing in the market. So the same in terms of the casino, they could say, well, we don't want to lose. We don't want to lose. I don't want to lose any hand. And that is not possible. Even the house, even though house always wins, will lose and undergo losing streaks. As a trader, there are some things you can eliminate. There are some things you can minimize, but there are some things that always will be there. And that is losing, taking stop losses. It will happen. Taking a loss, sorry, not placing it stop losses, but taking a loss. That is always going to happen. So I'm going to give you a little thing to think about in terms of risk reward ratio, and perhaps that is something you want to think about in terms of what is going to happen in terms of variables and certainty. So the certainty is when I toss a coin is going to be either heads or tails. That's it. Me versus a random person. The certainty is that is either going to be one of the two. And the variable fact is the sequence that it is going to come at. Because if I'm going to toss it once, and for example, I want head and the other one wants tails, and it comes tails, 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 that is something that is variable. I am unable to tell the sequence that is going to happen. However, there is something that I can put as an advantage to it that is going to help me win over, let's say, 100-time coin tosses. Okay. And that is that when the person that is plays against me, every time it lands on tails, they get $10. But every time it lands on heads, I am going to get $20. So that way I know that I have advantage in the game. So I am putting myself in advantageous position. However, first of all, I don't need to win even half of the time in order to win over them. And secondly, I don't need to know the sequence, because I know that at the end, I am going to be okay. So this is where risk reward ratio should be taking care of your things. And this is where you should not be touching your risk reward ratio if you establish one. And that is not saying that you should always have greater risk reward ratio, because if you are trading with one-to-ones and that is working for you, that's absolutely fine. However, all of that needs to be based on the data, what your strategy and your data is showing you. I want to 2 more profitable, I want to 3 more profitable, I want to 4 more profitable, etc., etc. Also, if we just take it as an overall picture, 1 to 10 is the most profitable. Doesn't mean it's sustainable. So obviously all of those things have to be taken into consideration in terms of sustainability, in terms of what suits you as a person, as a trader, your lifestyle, your commitments. You will be trading different time frames. You will be trading different times. You will trade different strategies, and all of those things will oppose certain things onto you. However, I've got a little story to share with you, which talks specifically about the variabilities and certainties. So the story is actually from the stoic analogy that involves an archer shooting at a target. And the book is, I think I actually have it here, is the Little Book of Stoicism. And I would very much recommend that book. So I'll show you in the camera and I'm going to give you a name afterwards. Okay, so the Little Book of Stoicism is actually great because it is all about, well, first of all, it's easy to read, that book, because Stoicism can be very complicated, but this book is written brilliantly. And of the things you can control. So it essentially teaches you that to a certain point, you are able to control things in your life and in trading and other factors about yourself, how you behave, how you make choices. But there are things past your choices, past your control, that you no longer have control over. And there is no point stressing yourself with those things, because if you do, then obviously you're putting yourself at risk, especially in the markets as a trader, and making more mistakes, emotional mistakes, and things that may just not work. So let me read out a stoic analogy about an archer. So the stoic analogy involves an archer shooting at the target. So the archerer, represents a trader, while the target symbolizes trading goals, profitability, hitting certain benchmarks and targets. The archerer can control only their action. So what can the archerer actually control? They can control selecting their bow, practicing the skills, shooting at the target before they actually do it, aiming at the target, their positioning, how far they are going to stretch the ball and stuff like that, right? So in trading, this all is an equivalent to developing your trading strategy, your risk management, and learning from past trades, from back testing, from forward testing. To certain degree, you have control. You have control over your risk per trade. You have control over losing percentage per day. You have control over your entries. You have control over pressing buy or sell button. You have control over placing your stop losses, setting your targets. You have control of when you are going to attend to the markets. You have control over your skill and how you are going to apply it. And you have control over yourself, even though it sometimes feels like you do not. You have a control over how you are going to respond to the markets, or you have to teach yourself that. However, past that point, your control is gone. So in this scenario that I've just said about the archer, what is the certainty? So the certainty, again, is the archer's skill, effort, preparation. That is his control. And this is the same with trading. Now, what is your control as a trader? Everything that I just said in terms of risk, etc. What are the variabilities? So external factors. External factors are always the variabilities. And just like in life, there are certain things and degree to you can control. And I'm going to give you very simple examples that actually are told in the little book of Stoicism that talks about control over yourself, how you talk, how you behave, how you respond to situations, how you process information. You have control over that. You don't have control over people's responses to you. You don't have control over the weather. You have no control over a driver that is driving right next to you. You can control your car. You can do the best thing possible, but that's, for example, how accidents happen. You know, there are so many things that you can do, but at a certain point you need to let go. And that is the variability, and we shall say lottery of life. So external factors for the archer is, once the archer has put the effort into their skill, into preparing, into selecting the bow, into positioning themselves well, into repeating the same process over and over again, once the arrow is released, his control is gone, because on the way to the target, there are factors like wind, like sudden movements that may affect the path. There might be genuinely the archery is so ready and the fly flies by him as he lets go, and that creates a sudden movement where he's going to be slightly off the target. There are so many different things that may happen. So in terms of the market, once you execute, that is your control and your risk management, or how you are actually, focusing on the management of your trade. But markets volatility, unforeseen events, whether the price is going to consolidate or going to give you a pure momentum, whether the price is going to get to your target, whether the market is going to hang about near your break-even point, or whether the market is going to go to your stop loss, you have no control over that. you cannot control the market. As much as you speak to it, as much as you may think you have that, you do not. And that obviously creates a lot of frustration because, as I said before, the market don't need you to be right all the time. You are asking from yourself to be right all the time. And that is what puts you in that stressful cycle. So now, what is the application of trade to trading and what you can do that is in your control? So obviously the skills, the planning, the education, attendance to these webinars, to workshops, to traders roundups, to talking to other people, to reflection, to how you are going to engage in your process before trading, during trading, after trading, how you're going to review your data. All of those things will help you to actually have an influence of what may happen over the mathematical equation, whether something is profitable or not, whether your skill is growing or not, whether your mental excellence is growing or not. All of those things will actually have an impact, but the rest will not. So I really would want for everyone to actually grab that book or start maybe reading little things about Stoicism, because Stoicism will teach you and understand certain topics about how to let go of certain things, which really can boost your confidence. So that is really something that I would want you to consider. Now, I am saying here that we have case studies, but those case studies are actually further down the line because they will be very much related to the random distribution. So I'm not dismissing them. I'm still going to show you them. But this is where I want to now, based on this discussion and about letting go and about not being able to focus on the variables, uncertainties, not being able to control the variables, how you can actually be certain about what is going to happen over a long period of time. So this is where risk management techniques come into play, and you need to figure out what works for you. Now, I tell you one thing that is very, very significant. Number one is the risk management has to work for you. Nobody can tell you what is right and what is wrong, because remember, sometimes you will be opposed with other people's opinions. You should not be trading one-to-one. This is what I do. And that's fine. If that works for that person, that is absolutely fine. You need to know what works for you. I told you before, there are some traders that are fantastic swing traders because their personality must suit it. And it's not just personality. Maybe they trained themselves that way from the get-go. Not only that, but maybe actually their circumstances at first forced them to be the swing traders, but then it actually did hit their sweet spot. There will be other people that could not for life be swing traders because they would be constantly be checking their phones, and perhaps they do not know how to approach it, but perhaps also they've never tried it. And maybe if they collected enough data and found that mental edge to be able to do it, maybe they would. The thing is, sometimes I see traders sticking very often that there is one time frame that holds on to traders and never lets go, and that time frame can cause traders to give them an illusion of quick gains, but it actually jeopardizes their growth. And I'm talking sadly about the 1 minute time frame. And there are some traders who thrive on a 1 minute time frame, but there are other traders who do not, and they are stuck in that vicious cycle because perhaps in the future they will be good on a 1 minute time frame, but at the moment they control in terms of their emotions and in terms of how they approach things makes them a little bit too impulsive in the way that they make certain decisions. So it really is about working about that. Number two is there is never a perfect strategy. There is never a perfect strategy when it comes to just technicals. There is never perfection when it comes to psychology, and there is never a perfection when it comes to risk management. There is never a perfection when it comes to entries. There is never a perfection when it comes to exits. So this is the reason why that perfection does not exist. Stop chasing that perfection. It doesn't exist, and this is the reason why we need to learn as traders via risk management techniques to always learn to take our piece of cake per day. So this is the way I call it. To me, the market is a cake. Bear with me. And our job is, with risk management, to daily, consistently, obviously it may not have to be daily, but to consistently take a piece of cake. And once we take that tiny little piece of cake, we eventually, piece by piece, we are actually building our own cake, which I refer to as, obviously, the goals and the things that we want to achieve as traders. However, there are going to be pros and cons to every strategy, every entry, every exit. And this is the reason why you need to, first of all, understand your technical side of things to be able to execute it correctly. So we will be discussing the risk management in terms of pros and cons. However, I want to first highlight how you should establish your risk management, because the worst thing is when the trader just says, you know what, I'm going to go for 1 to 5s. I mean, you know what, I don't really have to be right that much, but it's a great risk reward ratio. Every time I'm going to risk $100, I'm going to get $500 back. And that sounds like a great deal. And on paper, it sounds like a fantastic deal. And there are strategies that are going to support it. However, you need to recognize whether your strategy is able to give you that. And secondly, if you have the mental capacity to achieve that, because it requires certain mental edge in order to achieve that. Never should you ever to make any decisions about tweaking your strategy, tweaking your approach based on, I think this is going to happen in the markets. Everything and every decision should be backed by data, by backtesting, by forward testing. I understand that there are some people that dislike backtesting. You may find it better to forward test and to collect data from the live markets. Now, it may take you longer. However, it's going to provide you with great quality. Now, there are advantages to forward testing because you get the real feel of the market and you're actually executing in real time whilst you are testing a new strategy. So that is going to give you a great feel of the behavior and everything that happens. There are also advantages to backtesting. Whilst it's not going to give you that real feel of the market and candles constantly moving and behaving in a certain way, you can condense large amount of data in a short period of time to understand certain things. And those things that you should understand is about the following things. And I'm going to send you those following things in our announcement channel for psychology, that those are the things you should understand about your trading data to inform your risk management. Because if you think about it, your risk management is the mathematical edge that the house has, the casino, over the player. And you can only have an effective risk management technique when you truly and surely understand those aspects of your trading. So I don't want you to, kind of answer here, but I want you to pay attention to the things that I'm going to ask you and whether you have an understanding of that. So if you're watching it back or if you're here live, I'm going to ask you questions about your technical edge. And in theory, you should have an answer to all of those things. If you do, that means you know your trading edge inside out and you should be confident about your entries, exits, etc. If you don't have some answers, perhaps you should do more digging. And that doesn't mean that if you don't have those answers that the trading strategy doesn't work. That just means you need to do more digging to understand it a little bit better. Because then if you understand it a little bit better, that is also going to support your psychology. You're going to trigger confidence. As you're going to trigger confidence and have that mental impact of trusting the numbers behind how you execute in the markets, it's going to make it easier for you. You're not going to be doubting yourself. You will be then building that trust into the randomness of the numbers and understanding that it needs to play out over a long period of time. So you should understand those are the things that I'm going to ask you about your strategy, about your data, whether you understand about your edge. Do you have the number of your potential, average number of potential losing streaks? Do you have the average number of your winning streaks? Do you have an average time that you may sit in a trade? Do you understand your average risk in the markets? Do you have an insight into the average return per trade, so risk to reward? Do you understand and have an insight into what are the most profitable trading days for you, or sessions? Or is there any difference between days and sessions at all? What is your potential expectancy in terms of trades per day? Based on your age, how many trades per day do you usually may take, or per week? What are the potential losses per day that you may take? What are the potential winners that you may take per day? What is the potential of a losing streak in a week, in a month? What is the potential of the best month and the least month in terms of return? What are your averages so far? Those are the kind of things that you should be understanding, because such thing as average time in a trade is an important information to hold, because a lot of traders do feel anxious holding their trades, because do you know what? It's almost like when traders are stuck in a trade in drawdown, they have no choice. But as soon as they see the trade moving into their profit, this is where they don't want to let go of those profits, and they might be closing their trades early or not allowing them to play out or go break even too soon. So if you actually understand, you know what? My average trade takes 7 hours, 3 hours, 45 minutes, then you know what to expect, and you know that expectancy. All of those things really matter, and those things can inform how you may adapt your trading strategy in terms of risk, because there is not a fixed way of doing it. So for example, you could have fixed percentage of capital per trade. Okay, so this technique involves risking a fixed percentage of, does not matter, of the starting capital. So for example, you may always be trading, let's say you've got 100K funded account, and you always will be taking 0.5% trade of the starting capital. Okay, so that means it's $500. Doesn't matter whether your balance is in profit or on minus, you always take 500 in terms of that, so 0.5%. So obviously, what are the pros of it? So that means that you ensure that the amount you risk is always proportional in terms of the size of the trading account. But also what it means is that if you have a string of losses, you then are not putting yourself at additional risk, because essentially you are allowing for your numbers to play out. So if you go under a string of losses, losing streak of, let's say, 5 or 10 losses, where your average risk to reward ratio is 1 to 2, and you continue trading, let's say 0.5%, then it would just take you 5 trades to actually come out of that, you know. Now, another thing that you could be doing is, let's actually think about something else. What if you were trading 0.5% risk of the current balance? So not the balance of the starting balance, but actually you would be trading as a compound. So if you are trading, so it's going to be easier for me to give you an example, 1%, and you've got 100K, that's $1,000, that's 1,000. But if you, let's say, made 2% profits, and then you are trading 1% risk, that would be 1,200. So that way, every win and every loss kind of covers itself. And if you are undergoing the winning streak, this is when you are able to actually compound your profits even more. So those are all of the things that you could take into consideration. Well, what are the cons of it? So the actual dollar amount risk varies, which can be psychologically challenging. So for example, if you are trading, 1% of, whilst you have 5% in your trading account of profit, 105,000, and then your risk is going to be 1,500. Something like that. So then that way, you are obviously, if you are going to take a loss, that loss is going to seem like is a lot more. So you need to take all of those things into consideration. You may have slower recovery because if, for example, you went on or you undergone losing streak and you are on 95,000, then you no longer will be risking the full 1,000, but under 1,000, that is going to be in terms of your risk. So then it may take you slower to recover. Or what is the technique that you would be applying? Would you be applying a technique that whilst you are in drawdown, you want to protect even more the downside risk, and actually whilst you are, I don't know, let's say minus 2%. So you don't want to go more than minus 2%. So you start, let's say, with 0.5% risk. So that allows you to have 4 losses relative to your losing streak. You say, you know what, usually I have 3 of losing streaks the most. So worst case scenario, I may go into minus 1.5%, 2%, but I'm going to keep my percentage there at 0.5% risk. So then I can recover and I can have that starting balancing somewhere there. However, if you drop below minus 2%, you may decrease the risk, but then obviously it's going to take you a lot longer to recover. So there are different ways of playing with it. You may choose fixed amounts. So I know some traders that actually don't risk percentage as much, but they risk a dollar amount, and they say, oh, I want to, because and again, there's no right or wrong, and I am not encouraging one or the other. I just want to open your eyes of different ways of doing things, because some traders that I know, because they wanted to replace their salaries, they were kind of thinking, okay, in order for me to replace my salary, I want to risk $50 per trade, and I'm going on average for 1 to 3. So on average, perhaps plus minus some losses, I could potentially get $100 per day, and that could actually replace my salary. So those are the things that people are thinking about in terms of how they trade in. Some people may want to just trade despite of how much they have in terms of the starting balance, but they may want to risk $100. Whether they have 100K account, whether they have 50K account, they may kind of think, you know what, actually trading $100 per trade is enough for me, because then if I go for 1 to 3, that's $300. $300 easily is going to replace my salary. So those are all of the things that you need to think about. And again, there are pros and cons. And, the pros of doing a set amount of money can be to implement it easy and understand it easily, and you've got constantly the same risk, and you're just playing that, and you've got a certain target, and that's it. But obviously, that does it give you growth that you need, and you may start over risking or under risking based on your percentage. I personally rather to trade in percentages, but I know some people would rather to kind of trade in terms of amounts, and that is absolutely fine, because you capitalize differently on both of those scenarios. Then, as I have mentioned already, variable risk model. So depending on actually what is the amount in your trading account, you may establish that. Are you going to go with 1%, 0.5%? When are you going to drop to lower? Some people start challenges differently, or funded accounts. There might be some people that actually start more aggressively, and they first go with 2% risk, and they like, all right, the first trade either wins or I'm set back to minus 2%, and then based on that minus 2%, I will just drop down to 0.5%, and then I'm just gonna crawl my way back to break even and try again. I know some people that are doing 0.75% as they start the challenge, and they are waiting to, for example, bump themselves into 2% in profit. Once they are 2% in profit, they may risk 1, and then they have 2 shots again, 2 trades. Every time they would lose a trade, they would drop down to 0.75%, and again, when they bump it up slightly, then again they would risk a little bit more. And sometimes it will be a game of back and forth, but they are okay with it, because again, there is not a perfection. then as they grow, they may increase their risk to 1%, 1.5%. Now, if they decrease, this is where they are going to be more cautious. I know some traders that would start actually their challenges more cautiously, and first they're going to go with smaller risk, 0.3, 0.5, because it's very important for them to psychologically not allow themselves to drop in terms of their performance. So they would rather to always maintain within 1% boundary in terms of the drawdown, and they're like, no, I'm going to actually risk very little, and as slowly the account starts growing, this is where I can allow myself to only risk more once I have profits. Okay, there are so many ways of doing it, and you need to truly understand what works for you, what type of person you are, because what is going to help you grow, that is the most important thing in trading. We need to grow in a way to understand what works for me and what actually doesn't, what is making me to not perform as well as I could. And there are things that you can do and change in order to help yourself with that. So there is not right a way of doing things, and people will tell you you're wrong. No, you should not be doing that. I'm doing this. But it doesn't work like that. You should really be certain how you are going to kind of approach it. Now, again, some people would grade their charts and say, this is A star setup, this is A setup, this is B setup. On A star setups, I risk 1%. On A setups, I risk 0.5%. On B setups, I only risk 0.25% because I'm not sure of them, but I kind of want to be involved. So they establish what are the high probability setups and what are high risk setups. And based on those setups, they are going to establish their risk. Some traders may day trade and they may take the standard 0.5% risk, but perhaps they may sometimes see a swing opportunity and they kind of would rather to capitalize on that and hold that trade. And they see that the price is at the weekly high or monthly high or whatever that might be. And there they are going to actually set higher risk, but because they have a lot larger stop loss. There are so many variabilities, and you can be as creative as you want to be or as simplistic as you want to be. Now, in terms of this, it's not about less is more. It's about what works for you. What works for you in terms of everything that you are wanting to achieve as a trader. Everybody has different goals. Everybody's got different agenda. Everybody's got different strategy, personality, and all of those things will play a factor. And you need to make yourself a list of what are the pros, what are the cons, how could I approach a challenge, funded account, personal account, how am I going to do it? How am I going to practice it? And those things are going to help you to establish it. However, that can be only established, and I'm going to repeat it again, by understanding your losing streaks, winning streaks, average time in trade, average risk, average return, trading days, sessions, what's more profitable, what's least profitable, what is the expectancy in terms of your 1 day, week, a month. What about losses per day? How are you going to cap your losses? Because sometimes the markets just consolidate. How will you recognize that consolidation is here? What are the things that you are going to do in order to understand it? And that means you need to dive deeper into your data and understanding your data, because only because something doesn't work, that doesn't mean your strategy doesn't work, but perhaps you haven't explored it enough. Okay. So now I want to kind of highlight the random distribution results, because random distribution results is the case study that I wanted to talk to you about. So there is a case study and there is also something else. And let me read out the case study for you first, and then we're going to take a discussion. So in terms of the case study, I'm going to give you a case study of a trader that earned 10% in a month. Okay, they earned, so let me grab the pen. They earned the 10, so not this, but 10% in a month by trading on 15 minutes time frames. In terms of 15 minutes time frame, not time frames, 15 minutes time frame in terms of their entries, and they risk 0.5% per trade, and the average duration in the trade was 2 to 4 hours. Now, overall, remember, they profit for the month was 10%. 10%, not 16, 10. But let's think about it. Overall, the 10,000 account, 10,000, 10K, grew to 11K. All right. And they took approximately 80 trades in a month. All right. Again, not up to us to judge whether that is a lot or not a lot. It's the trader's edge that made them 10%. So week 1, they had unsteady week. They took about 20 trades and 8 of them won and 12 of them lost. The net result was actually minus 1%. After all of those trades that they took, 20, their capital went down to 9.9%. Week 2, so that's it, loss, 20 trades, 8 winners, 12 losers. That is where they are at. Week 2, they took 18 trades. And that was more of a recovery week for them because they have had 12 winning trades. Let me just do this. 12 winning trades. And they had 6 losing trades. So the net result was 3% gain. Okay. But obviously from the week before, they were on 9,900 because of the minus 1% result. So from the week 2, when they got 3%, they are overall in 2% profit. Look, week 2 of the month, they are only at 2% profit, but at the end they got 10%. Week 3, what has happened in week 3 is they had strong performance actually, and they took 22 trades and 14 of them won, 8 of them lost. They got 4% gain. So they had from week 1, remember week 1 was minus 1%, week 2 was plus 2%, and now they got 4% gain in week 3. So they overall now balance is at 6%. Now in week 4, they had a bit of a mixed results. And they got, a bit of winning, like kind of 10 winning, 10 losing, and they got another 2% in terms of the gain. So that allowed them to be somewhere around, so actually it was 8%, somewhere around 10% gain. Now, it took them 4 weeks and there was a mixture. And, during the period of week 1, where they actually ended up on minus 1%, they were winning trades, but they were losing trades. And they were winning trades and losing trades. But the factor is that is what our job is as traders. It's not just about what we would want it to be, which is taking profit. But when you start somewhere here, let me make you that drawing. When you start somewhere here, okay, and this is your 0, so let's say 10K, all right, this is your starting balance. You have to think about a few things, okay, because there are going to be a few things that are going to affect you as a trader. Sometimes, and as I told you, different traders will start differently. Sometimes a trader will start on minus, and once they start on minus, this is it. The spiral has started. Sometimes when traders start on as a winning streak, first trade is a win, second trade is a win, they perceive the markets differently. So when you start your challenge or you're funded on as a loss or second loss or third loss, this is where doubt can creep in. Whereas if you started it on, because it's random, if you started on a winning streak, this is where your confidence is there, etc., etc. It would be mixed results. What I think would be the best for traders is to have no idea what their balance looks like. They shouldn't know whether their starting balance is 10K, 12K, whatever, where the profits are left there, whether you are on minus. Because if you actually did not have a clue if you are on minus or if you are in profit, you would perform at your best because you would only take into consideration the performance. But when you will start taking into consideration your P&L and where your account is standing, this is where problems sneak in. Because when traders are on minus, this is where self-doubt sneaks in. And sometimes when traders are on the rise, this is where overconfidence sneaks in. And this is where overtrading or over leveraging your position sneaks in. Over leveraging also happens here on the miners because people want to gain their profits back very, very quickly. So you have to understand that about yourself now. So yes, I said to you, understand what is going on in terms of your trading edge, but now and understanding your mathematical edge to inform your risk management, we need to now also think psychologically, what does work for me? What does not work for me? How would I start? How should I start the challenge? Am I okay within certain means? Am I not? Because I tell you something about the case study of the trader is that the first week, essentially, they ended up on -1%, but for the duration of the whole week one, where at the end they were in profit, so week one, they were just bouncing around the break-even balance. And that's what trading is sometimes, because you are a risk manager. You meant to manage your risk effectively around whatever is the starting balance, and then manage the risk, whatever the market conditions are. Maybe you're undergoing losing streak. Maybe there are no entries in terms of your model. And then it should be like this. This is what trading should be like. And this is what trading or traders want the trading to be like. So this is what trading should be. This is your starting balance. Up. 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 That is a healthy equity curve. It's almost is the same like the markets, that we have impulse, correction, impulse, correction, impulse, correction. You should be managing your risk and then have steady growth. Managing your risk, steady growth. Not every time you go on a slight downfall, this is where everything, freaks out. The worst equity curves are the equity curves that go like this and like this, like this and like this. They've got very sharp moves up, very sharp moves down. That is not a risk management. That is a bit of emotions that are sneaking in there. But healthy curves look healthy. And sometimes those healthy curves may start here, and then eventually you will see growth. And it doesn't matter whether that growth happens under the 0 par when things are on minus, or whether they are in a positive. So just remember about it, that it is all psychological and how you perceive being yourself in drawdown or not. And during the last traders roundup session, I said one thing that I think traders forget about. Drawdown is there to be used. The minus 10% is for you to use, because if we did not allow you to use the minus 10%, that means we would always expect from you to be right. That's not the case. This is your playground. It's all right to be on minus, as long as you are obviously executing according to your strategy. That's all that matters. But nobody's expecting you to always be in positive. It is okay to manage your account at break even somewhere on a minus. That's absolutely fine. That's what trading is. If it was just profits, none of us would be here. We all would be in Bahamas somewhere, all be millionaires. There wouldn't be a struggle. But there is a struggle, because if I randomly had given you an account and you didn't know the balance, I assure you, you would be focusing on performance. But if I said to you, I'm on minus 5% and I need to get 8%, ooh, this is where trouble starts. Well, I'm starting from the negative balance. If I told you, and you know what you would be thinking about? -5 and 8, I need to gain 13%. Whoa, that's impossible, Paulina. I'm not going to do that. However, I assure you that if I said to you, the balance is on +5%, and I want you to make additional 13%, you'd be like, oh, that's doable. I can do that. And I understand, because there is a downside risk. Here is different. But actually, if you executed your edge, you potentially would be surprised how easily and quickly you can get yourself from a drawdown if you did not overthink, if you did not over leverage, or if you did not be overly anxious if it's going to work or not. This is the reason why I encourage you to very much understand the probability of your toss of a coin and how your house works in terms of your trading edge and probabilities and action, and for you to become the casino and have that golden rule that you don't change the rules based on how you are feeling or losing streaks, because casino doesn't do that. Emotional players do that sit at the tables of the casino, but casino always remains calm and executes its mathematical edge. But in order for you to be able to understand your mathematical edge, you need to go into your data and you need to understand the random distribution of your data, because one thing that is going to happen in the market over and over again, even though you've got a winning strategy, you may start with a loss. So hold on, loss, then you get win, break even, loss, win. And at the end of it, let's say you would be in 5% profit. But the problem is, because you start with a loss, your brain goes on a full freak out mode and you no longer allow for your trading edge to play in favor for you. Whereas if you actually would allow it, that'd be fine, because it's way easier to start with win. And then, all right, then if you take a loss and then win and then loss, it doesn't feel so bad because you're already in a positive. But you have to train yourself not to respond to the negative or positive equity in your trading account. You should be executing the same regardless of what is in there, not overthinking, but going for it. And this is where understanding your data can help you to achieve that. So I hope that I had given you an insight into what needs to be done or what cannot be done and stuff like that, and to really have a think to understand what it is that you need to do, the extra work that you need to do to understand the numbers behind the way you need to execute things. And I'm going to, again, put that list in the Discord announcement, psychology announcement, for you to kind of think, okay, do I understand this? Do I understand that? Do I understand this? Because that really is going to support your mental edge. Okay, let me just read some comments. So Kennedy is saying, you're right, I started a challenge and then went into drawdown. The emotions have been a challenge to keep in check. Yeah, and that's natural. You know, we are humans and that is natural. But because we understand that that is natural and that we are humans, we have the power with that knowledge to actually make a change and equip ourselves in extra skills. And as we equip ourselves in those extra skills, we can learn and we can move forwards, because that's what it is about. We're not going to just naturally be good psychologically at trading, because it is against the human functioning. So you have to understand, I'm not good at this, I'm not good at this, I'm great at this, I'm great at that. But there are things I need to work on. So you should flourish in the areas you're good at and also understand the things you're not so very good at and grow those areas. That's absolutely fine. If you understand that perhaps being in a challenge and being on minus throws you off, hide your balance. Genuinely, it's those simple little tricks that you can do to help yourself. I used to hide my balance completely, so I was just focusing on execution and seeing the price move. And then I was actually also hiding my MT4 so I could only see it on TradingView. So then I was not fixating, because the more we expose ourselves to our balance, oh, it's moving up, it's moving down, we get attached or we get anxious. So this is where just don't look at it and allow for the price to do whatever. And for me, it's the best to set my trade and then sometimes get on with something else. And then I'm like, oh, wow, the trade moved really nicely. And I had not even a chance to tamper with my trade, because to allow for it to play. And I guarantee you, and just reflect back on it, that if all of the trades that you took in your trading career and you did not close them too early or do this or do that and actually allow for your personal views to get in the way of that trade playing out, you actually would be in a way better position. Because anytime the human part sneaked in, this is where we've got our potential. But if we actually left it to our analysis, because There is a difference between having your analysis and allowing your analysis to play. But this is why you need your technicals, your mental excellence, and that is going to inform your risk management. So guys, if you do have any questions, please do let me know. If you can't think of something right now, but you're going to think of something later, that's absolutely fine. You can always message on Discord in our psychology channel and we can chat there. Otherwise, it's been my absolute pleasure to be here, and I will catch you for our Traders Roundup on Friday at 7 p.m. on Discord, where I will help you to reflect on your week and see how you are doing, whether I can help you in any way to reflect, to learn from it, and prepare you for a Monday. And also on Sunday, we have a webinar at 6 p.m. as well. So thank you so much, guys. Have a fantastic evening. Have a great rest of the week in the markets, and I'll see you soon. Thank you. Take care. Bye-bye.